Hey guys, Jason at Hard Money Bankers and Hard Money Business. Today, I want to discuss the different types of capital that is out there right now for hard money lenders. You obviously have your traditional private capital, private lenders, which we encourage and we like, and which we've been using for the last 11 years. And you also have institutional capital that's very popular right now. Obviously, there's some benefits of taking on institutional capital, but there's also a lot of downfalls with working with institutional capital if you are a hard money lender. So let's kind of just go through both of them just so you fully understand, and then you can make a business decision of what works best for you. So institutional capital. It's very easy to get these days. We've been approached by a ton of institutional lenders, Wall Street money, all kinds of different capital sources because they want to deploy money in our space, in the hard money lending space. Now, obviously, the biggest advantage is, well, two big advantages. Number one, they have lots of capital, endless amount of capital. Chances are you can't nearly deploy the amount of capital that they have. And number two, it's cheap capital, right? We give our private capital investors note rate -3 or 4. So typically, 9 or 10%, which is usually a good rate of return for private investor. Institutional capital's 5, 6, 7%, a lot cheaper, and there's a lot more of it. So, if you're starting out, it's an attractive approach to go to an institutional lender. And like I said, there's a lot of them out there trying to deploy as much money as they can in that space. So terms and the availability are the pros. Now, that comes with a little bit of cons, right? Typically, if you're going to go that route, all the borrowers, no matter the LTV, you can lend $100,000 on a $6 million building. The borrower is still going to need tax returns, financials, 12-month asset statements, good credit, and they can't close all that quickly, some of these institutions. Now, as you create a relationship with them, typically, you're funding it and then selling it to them on the back end, or you're drawing off a line when you go down that road. But that being said, it's not happening overnight, like if it was your own money or if it was private capital investors' money that was parked in your account that you had easy access to. Sometimes you got to use those institutional service providers as well. So it's all things to think about. I'll be honest, a lot of the lenders here locally, all of our competition is using institutional capital right now. We are not, and I'm happy we're not, and I'm going to explain to you in a second why I'm happy that we're not, but it is a popular source. So just think wisely on it when you make the decision. We like to have flexibility to do whatever the heck we want to do with the capital. And obviously, we have to do proper due diligence, and we have private capital investors in our own personal money and clients' money, business money that we have to protect. So it's not like we're making bad decisions with that money. Just because we're flexible doesn't mean that that's necessarily a bad thing. But I don't want to kind of pigeon ourselves into a box that it has to fit into this. And if it doesn't fit, we can't do the loan. That doesn't work for our model. I don't want to have a good borrower that we worked with for years come to us and say, I have a loan that's closing tomorrow. Can you close it? And me not being able to do that. Right. So we want to have the flexibility of doing it our way. And let's be honest, institutional capital is not going to be around forever. It's the new sexy thing. It's been the sexy thing actually for a few years now, but it's sexy, and they're getting good rates of return, and they're able to deploy a lot of money into the space. So I understand why they're in the space, but they're not always going to be in the space. A lot of our local competition has had to not use their private capital and their private lenders, and they're using their institution now. What if that institution pulls the plug? You're out of business. Doesn't fully make sense to me. Now, it's enticing to be able to be like, okay, I used to only have access to this much money. Now I have access to this much money, right? Also, a lot of the local guys that I know, they're able to lend nationwide now. Really, they're just mortgage brokers. Instead of brokering conventional paper, they're brokering, or subprime paper, they're brokering private, I shouldn't say private because it's not private. They're brokering fix and flip paper, rental loan paper, things like that. So obviously, like I said, as a business decision, you got to think about what works best for you. Having access to private capital, your own private capital that you control what you want to do with, you make the metrics, you just have so much more flexibility. You can close quick on deals. Hey, if you have a 659 credit score instead of a 660 credit score, you can still do it. You can determine what you want to charge. It just makes a lot more sense in my mind. So, I didn't get into this business to do a lot more deals and make a lot less money. Keep in mind, if you're lending out a lot cheaper, even if your money is cheaper, you're still making less margin on it. Institutional capital out there that we see that these guys are lending out, it's 8-2, and they're getting their money at 5, 6, 7. Plus, they have to deploy a lot of money in order to keep that line of credit from these institutions. Listen, I'd rather do a small amount of deals and make better margin on my deals. And even if they're more expensive, even if a lot of our good borrowers that we worked hard to keep have outgrown our program and go into cheaper capital sources, that's okay. That's fine. So I want to sum this up with one thing. And I talk about this a lot because I'm passionate about this. And this is what we do regular. You got to think of yourself as a marketing business. You got to have deal flow. If you get on the phone with somebody and they say, listen, I want to go with you, Jason, but these guys over here, they're charging me 10-2. Great. Unfortunately, I can't help you. We're going to be at 13-3. That's just where we're at. And you know what? The reason I can get away with that is we have deal flow over deal flow over deal flow. If I charge 10-2, I make a lot less money than I charge 13-3. I'd rather just do one loan at 13-3 than two loans at 10-2 and make the exact same margin, the exact same amount of money on the back end. So just think through that a little bit. The private capital, kind of where it's at, especially as the market turns over the years, you have those private capital partners that are partners with you, true partners with you. Let's say you have a line with a big bank and an institutional and a deal goes sideways and they're like, cool, well, we got to call the loan. Someone's responsible to pay me back. You have a private capital partner, a deal goes bad. Hopefully you have a good relationship with them and it's cool. Well, you know what, Mr. Smith, this deal's, God forbid, and this is if things really go bad, might be a deal that you have to sit on a little bit longer. You work out agreements with it. So having good capital partners, having good capital investors and partners just goes so far. It's really important. I can do a video in the future related to the importance of having those good capital partners in the good times and the bad, but they're strategic. They're doing it the right way. Even if it takes you longer to grow with private capital, it's a good route to go with. So hopefully you find this helpful. If you need anything related to this topic, reach out to us. Every once in a while, we do consulting in our office for hard money lenders from different areas. We only take on one lender per market because we keep it exclusive. We give these lenders our playbook of exactly what we do. We build them into our kind of sphere. We give them leads in that area. So we do have an exclusive right to a particular area. And to be honest, a lot of the areas are taken. We have guys in different parts of the country already. And, again, I'll give you an example. We have one of our partners in Richmond and, can't take on consulting in Richmond. We have someone in South Florida, can't take on consulting in Florida. Denver, Colorado, same situation. Wisconsin, same situation. So there's a lot of different states that are already taken, but hey, if you're interested in consulting, maybe we can work out something and help you. Feel free to reach out to you. The best bet for that is just, go to hardmoneybusiness.com and see if there's any availabilities in your state. If you need anything, hit us up.